Hello, everyone. Welcome to the Truth About Real Estate Investing show. I hope you all had a great weekend. My name's Erwin Cito, for those who don't know. I guess some people do know. I hope you all had a great weekend. I know I did at Seth Ferguson's Multifamily conference. I know it's a huge ordeal for him, being the first big real estate conference coming out of the pandemic that was live and in person only. I'd recommend you buy I get nothing out of this, but I'd recommend you buy the recordings if you missed it. The speakers were great, every one of them. I took notes from pretty much all of them. I did miss some speakers because I was just enjoying myself so much in the hallway with a lot of people I haven't seen since 2019. So literally some people I haven't seen since my own conference in 2019 at the Wealth Hacker conference. So it was great to just see people I hadn't seen in ages, hugs and smiles and no masks. Anyways, Kevin O'Leary was especially excellent, I thought. I know he rubbed some people the wrong way. He actually led off and explained it as it's something his mother taught him to never tell lies. So you don't have to track what lie you told who. Hence Kevin takes it a step further. He actually tells people what he thinks, even if they don't want to hear it. Hence, he gives people his opinion on their business or investment, whether they're good or bad, right? Versus other sharks or dragons will only just say they're not interested in investing, and leave it at that. Versus Kevin will tell you if he thinks you have a bad business and you should stop investing in it. So I share some of Kevin's values. My journey is a little bit different. We have the show. And the show's entirely been about truth seeking in the real estate investment space. We do make mistakes, and we course correct when we do. I've taken down at least 2 episodes, maybe more, when we had a bad sponsor, or we mentioned a company that didn't do good things. Paramount's the name of that company, but that was years ago. That's quite a while ago now. The founders can't be found and the cops can't find them. And so terrible things. Anyways, so along that line, as you would expect with capitalism, there are many bad investments. There are many bad people out there. Just this last week, I've been chatting with investors. I chat with investors all the time. I was chatting with one who had invested quite a bit of money into a growth tech stock that uses artificial intelligence. He lost a bit of money on that. Another investor with 3 private mortgages from just a couple of years back from a company that most of us know the name of. Only on one of those private mortgages has the capital been returned. Getting the rest back is unlikely. I'm hearing from sources that some REITs out there are in trouble. Newer REITs. None that I've invested in and no one I've had on this show. Thankfully, my due diligence has kept me out of trouble, and I've developed my screening process from just simply reviewing what makes deals go bad. Even pre-pandemic, anytime a big condo development goes bad, I read into it. I want to understand what went wrong so that I can avoid problems like this going forward. So quick Coles notes, I've noticed some commonalities among failed developers, and some of them are they're paying interest. The projects are debt financed, as in the acquisition of the land is debt financed. So just imagine if you're like a condo developer, for example, it's going to be years before you actually have any money coming in. So if you're paying interest on that piece of property that doesn't have money coming in, that's a risk. And another big risk is if it's a less experienced developer. Again, a commonality was often it was the developer's first big project. And then you throw in a pandemic, historical inflation on labor and materials, and you just have a formula for failure. And I don't fault people for deals going bad, but it's not something I'm going to put my money into. Let's talk about crypto. Crypto investors like myself. I only have a small amount. When I like to call myself educated. When I started reading more about it and talking to more people about Bitcoin and Ethereum, for example, they're both way down. But when I started looking into it and putting some money in, I knew the prices were high. So I was looking for a dip to get in. So yeah, we're dipping now. I spoke to a successful apartment building investor just on the weekend, and I know we know each other for quite a while. I know he made a killing on Boeing shares. Boeing, the plane, they make planes, jets, and they have lots of government defense contracts. He made a killing after the pandemic crash, just owning that stock, and he managed to give it all back on cryptocurrency. I do believe in cryptos. I don't know that much, hence I'm focused mainly on Bitcoin and Ethereum, and not even a large amount. My theory is that Bitcoin will likely make a comeback, but that's hardly a guarantee. Year to date, as I record this, we're about mid-late May. Year to date, 2022, as I speak, almost everything is down, including real estate. From what I'm seeing on real estate that I follow, like I personally invest in, we're back to December prices at least, maybe even November from last year. So therefore we are down on the year, even though February and January are just like tremendous months. Again, grateful for my clients who took action on that information and sold at the peak. The only things that are up this year in 2022 so far is oil and the US dollar. Even gold is down on the year. Or even gold down or even. Last I checked, it was down, just barely down. So basically it's even in this inflationary environment. Who'd have imagined that? What's working though is boring investing, investment properties with positive cash flow, as in tenants are paying you rent. That's performed extremely well, and they've not gone down. The whole investors can hang on to them, unlike people who speculatively bought single-family detached homes in the GTA, for example. That will never cash flow, or like a pre-construction condo, which, on the pre-construction condo side, I'm hearing some are having trouble qualifying for financing. I'm hearing this from mortgage people and from lawyer friends of mine. Some people are out there are having trouble qualifying for financing. I'm not even sure if they ever planned on closing their exit plan. There's going to be some people whose exit plan was to assign and had no intention of ever closing, which would include getting financing, let alone becoming a landlord and rent out the apartment. So I'm sure we'll see some softness in the areas of the greatest speculation without cash flow. Kind of like we saw in the stock market. On the stock side, generally stocks that pay dividends have fared significantly better than their speculative counterparts, like high-flying tech companies that don't actually make any money. For those who understand stock options, a disciplined approach to selling far from the money and using insurance has performed better than those who were less conservative. Slow and steady wins the race, like Warren Buffett has. Hence, we'll continue to teach defensive investing both in my real estate business and our Stock Hacker Academy. Anyways, that's what I'm trying to say. What I'm trying to say is that gains are easy to make. Keeping it is another matter. Slow and steady, like buying economically, fundamentally sound assets like that cash flow, has time and time again proven to be a winning strategy. Hence, and add to that time in the market. That's why Warren Buffett is the most successful investor out there. I'll be looking I'm a value investor myself. I'll be looking to buy this dip with a focus on quality. Speaking of quality, I mentioned earlier Kevin O'Leary's presentation, and especially his Q&A revealed a ton of great information. Unfortunately, Kevin wasn't allowed to do any sort of fan interaction. I was supposed to have my picture taken with him as part of being a VIP for the event. I was disappointed, but then after seeing the Q&A, I was like, that's awesome. I got way more value from hearing from Kevin's thoughts during the Q&A than I would from getting a picture with him. And I'll share my takeaways at Cherry and I's Real Estate Meetup. As Kevin shared his thoughts on the crypto market, on the economy, if there's going to be a recession, all those sorts of things. I took lots of notes. I even recorded part of it. And I need all this sort of information it'll form part of my presentation on investing through a recession. And also at that meeting, my team of award-winning coaches will be sharing on the latest that they're seeing on the streets in terms of real estate rental prices and resale prices. And our keynote hour-long presentation will be around garden suites. Garden suites is for most folks who are turning what was a single-family home now into a triplex. and it's what I consider the final major value add strategy for the vast majority of real estate investors. So it's something you don't want to miss if you're in it for the long term. We'll talk about renovation strategies to maximize rent return on investment, of course, financing, building, code, zoning. This is a very new strategy. So we're going to give you an update on where we are in each of those areas, because you need to know if you want to get on this on the ground floor. So you don't want to miss it. Saturday, May 28th, same time and place, 8:30 a.m. at our offices at Iowan Real Estate. Information, if you're on my email list, you get all the information to register already. We're doing in-person only. That way there's tons of great networking to be done. I don't know how folks network over Zoom, when only one person can talk at a time. This is much better. And yeah, I'm really enjoying the in-person events again. And again, only for those who feel safe to do so, you're more than welcome to attend. Right. Oh yeah, and then of course the networking has been fantastic at my events. We're not like other events out there, because naturally many of my clients attend, and they've done really well. They're really nice people. We're having more and more folks retire. So and my policy is always to learn from people who have what I want. So we'll have several recent retirees from real estate investing in the room. So you don't want to miss it. So on to this week's guest, Christian. Give me a second. Szpilfogel. He's one smart guy with a difficult to say last name. He's a former tech executive who worked closely with Canadian tech billionaire Sir Terry Matthews. For those who don't know Sir Terry, I believe he's still a top 10 richest Canadian. Anyways, he's implemented several He uses highly analytical approach and technology-based strategies to maximize returns on his multifamily investments. Christian detailed the top tech apps and devices for ROI on a past podcast, so check that out if you haven't already. The water meter monitor could save you thousands of dollars via early detection of water leak. Christian's smart on the EQ side as well. As his ability to communicate his renovation and development plans with the neighbors has enabled him to obtain their signed support so that he can go to the city and get his variances and permits approved. He shares how he's finding deals, getting offers accepted in multiple offer situations, and even having sellers call him directly. Cherry and I will be videoing and touring. Well, we'll be touring and videoing some of Christian's properties in early June as part of our Ottawa tour. We're in town just for 2 nights. We're even hosting a casual meetup in Centertown on June 7th at 6 p.m. And on June 8th, the day after, Cherry will be the guest speaker at Oreo, the big Ottawa networking group at the Infinity Convention Center. There's a link to register in the show notes on our website at truthaboutrealestate.investing.ca. If you're on the email, you get the show notes. It's wise to get to be on our email list. You get some quality information in a timely manner, and it's all free. It goes right to your inbox. Just go to my website, www.truthaboutrealestateinvesting.ca. Put in your name and email on the right side, and you'll start getting notifications on when we're hosting events, when we have new podcast episodes, and of course the show notes, so you can register for great events like Oreo on June 8th because Cherry will be there speaking. Christian's a good guy, and he's not here to sell anything. He self-funds his own projects with his own capital, and please enjoy the show. Hello, Christian.
Hey, Erwin.
Good to see you again. What's keeping you busy these days?
Yeah, that's you always love that question. So, and you know me, I'm always really busy. So it's we've had
I think you sound busier from what we discussed before we start recording, but let's go ahead.
It has been busy. Our portfolio continues to grow. We're still doing acquisitions. It's interesting. I was having a discussion with a local realtor yesterday over lunch, and he was saying, that the housing market, there's a lot of people starting to put listings on. I think they're kind of worried that they're going to miss the boom cycle for sellers. And so he's seeing a lot of people putting listings on, getting off the fence. about it. So I thought that was interesting. But the other thing we talked about was that, I've always said that there, just because the market's hot doesn't mean you don't buy, right? You stick to your principles and your decision criteria for purchase, and then figure out, well, you want to have certain criteria, but you can find what you need to find even in a hot market. It's just that when the market's hot, they're just harder to find. When the market is soft, they're just a lot easier to find and meet your criteria. And so we have done acquisitions even over the past year since we last talked. We bought another building that's going to be a repositioning project in downtown Ottawa in the Centertown area. Mm-hmm. We bought a portfolio in a town called Almont, right, which is literally just outside the Ottawa border, the city of Ottawa border, very near Carleton Place, which I bought in there about 5 years ago, and now everybody recognizes that it's really doing very well. It's a very interesting town that's really growing. Almont, I think, is going to be probably the next one. It's just 5 minutes away from Carleton Place. So we bought portfolio there. I was talking to just before we went on air, that one, people say, oh, you can't find cash flow properties in a market like this. Well, this was a portfolio of mixed use buildings that I ended up buying at 6 cap. That's what it worked out to. And that's with full conservative underwriting. So that assumes, for example, 5%, 5%, 5%. So property management, maintenance, as well as capital reserves are built into that underwriting. And then the other key piece in there is the rents are about 35% under market. So it's there's lots of upside in this property as well. So yeah, it's still possible. You just need to turn over the right stones.
So were these stones on ICX, or were they were these stones that you were turning over? How'd you find the deal?
So that's a really good one. So this one we found. Let's say the deal found us.
Oh.
Okay? So I didn't go looking for this deal. The deal came to us. Mainly because we're really very active in certain markets. And so we were known, and a realtor actually had this under contract for himself. He had done a decent job of underwriting, not perfect. So we cleaned it up and adjusted the price accordingly. But he had it for himself, but he wasn't confident in being able to execute on the long-term project. So he called us up and said, would you be interested in this? And we were literally his first call. And I did, so sure, send me the numbers. I'll take a look at what you've got. I did a quick pro forma on it. I was like, yeah, we need to take a look at this, right? Because if the numbers are right, this is either an amazing deal or this is a disaster of a portfolio. So we arranged to see it the next day. Went out, met the seller, met the realtor, and the buildings were in great shape. I'd say about half the units were already, well, actually 3/4 of the units were reasonably recently renovated. And then a quarter were in really rough shape, like they're going to be total renovations, right back to the studs renovations for those units. And then they had good quality commercial tenants in the commercial units with decent triple net leases, properly structured. The leases were weird, but because the seller was a bit naive and kind of new to this stuff, but he hadn't done a bad job of structuring the financials with it. And then a number of those commercial leases are coming up shortly as well, so there's a chance to reset those prices. I've already done one actually. So that's kind of how the deal came to us. And then the whole process of the acquisition was interesting. This was it was a bit challenging because the seller, this is the only portfolio he's ever owned, and he's only owned it for 5 years. I think in hindsight, he got in over his head. And I think he just needed stress relief, which was the reason he was fundamentally selling it. And so because he was naive, of course, a lot of the normal due diligence process was difficult. Simple things like I need estoppels for the commercial tenants. I need acknowledgement of tenant from the residential tenant. And he said, you know, and I was just getting tons and tons of pushback on this stuff. And I had to keep explaining to him why we were doing the things that we were doing through the due diligence process. So that was a bit painful.
Hey, how did the seller own this building? They inherit it? Like what?
No, he was an engineer who had some money and thought real estate would be a good thing to own. And he picked up 3 of these buildings, you know, on his own. He's a clever guy in reality, but I think the stress of managing tenants was too much for him.
The human aspect, or because there was like tenant issues, like can't pay
Oh,
rent or something like that, or
there's always tenant issues, right? On a portfolio that size, there's going to be tenant issues, and especially.
Apologies. Let's back that up. How many tenants are there?
There's a total of 27 units in the portfolio. So, and it's about there's 6 commercial, and then the rest are so 21 residentials.
That's a lot of relationships.
It is for
just trying to remember that many names.
Yeah, well, for a new person, that it's a bit overwhelming, right? So fortunately, we've got processes to handle all this. But he also had some challenging tenants that he's worked through. There's still a couple of challenging tenants in the building, but he did a lot of the cleanup, to be fair. But I think it really kicked the stuffing out of him.
Right. So the gentleman did the 3/4 of the units that were renovated. That was this gentleman?
No, he did a little bit, but most of it was done just prior to his acquisition of the buildings.
And how long ago was that? Was the seller's acquisition?
He bought it about 5 years ago. So no doubt he was selling it as soon as his fixed rate mortgages were coming up.
That's tough too, because do you know what their financing was like? Because this is mixed use.
Yeah, no, it is mixed use, but the commercial space is literally just under the 30% mark. I think it works out to about 27% on average of the gross leasable area, which gives you a lot of flexibility. So I was able to finance this with CMHC backing it. And that's a whole other thing too. CMHC, it seems to have turned a corner. So let me put it to you this way, Erwin. I'm going to ask you, if you're doing CMHC on a commercial building, how long does it normally take for them to get back to you on that underwriting? How much do you have to provision for in your agreement of purchase and sale?
Well, I haven't personally done commercial with CMHC. We've been doing our deals with BDC, and at least 2 months.
Yeah. Yeah, that's right. So most people, if you're doing CMHC on a commercial multifamily.
Sorry, this is back that up for the listener. You don't know if you have financing until that time has passed. You're in limbo for that long for financing. All right, sorry, Christian, continue.
Yeah, well, so with commercial residential buildings, so that's anything 5 units or more for residential. And you can include mixed use as long as the commercial space is less than 30% of the total gross leasable area. So CMHC, so just sort of for our newbie friends listening in, when you have CMHC financing, it does a few things. One, it technically allows you to buy it at a higher loan to value, and you could get up to 85% loan to value if CMHC is insuring your mortgage. It almost always results in at least a full point discount on the interest rate versus not having it insured. And you can get longer amortizations. I've had one building, for example, where it's a 40-year amortization insured by CMHC. But the downside with CMHC historically has been the very long lead time. Typically 10 weeks is what we would budget for in our agreements of purchase and sale, right, to put in place. I heard somebody had CMHC funding, or not funding, but CMHC approval in about a week. Somebody mentioned that to me. Yeah, somebody at Kingston mentioned that to me in December, and I was like, okay. I went back to the lender and I challenged them, right? I said, hey, let's see if we can do this in a week. Let's get all the paperwork lined up, everything done, so that we put it in the way that we expected CMHC wanted to see it. You know how fast the approval was? 4 business days.
No way.
I have never seen this in my life.
Can CMHC allocate some resources to the LTB?
Yeah, there's hope maybe on that side, but I do believe CMHC increased the size of their underwriting team, which I think is part of it.
Can we have some of them for like adjudicators? You can cross train these people. Sorry, Christian. Just to back up, for folks not familiar with commercial financing, so you mentioned that you had 10 weeks, that you allocated 10 weeks for financing approval. Yeah. Is that in your offer, as in like your conditional period?
Yes. Yeah. So that's actually quite normal for commercial processes, especially doing CMHC. So I did a building a year ago, and I had a short conditional period. Even though there was 15 offers on the building that I ultimately bought. Yeah. Oh yeah. Multifamilies are in rare supply. And that's a whole other discussion on that side. But in that one, I still put a conditional period, but I had the advantage of being a highly credible investor, right? So I had enough of a reputation with the real estate agents that they knew that I was going to be able to execute on this deal. And my conditions were really very simple for that one. It was inspection and insurance. And really, that was just to buy a couple of weeks to make sure we had some time from a due diligence period. And on that one, I knew I didn't need CMHC underwriting. But even if I did, all that happens in the deal is if you underwrite it with the assumption you don't need CMHC, so you're going to just do conventional financing, 75% loan to value at the prevailing bond rates, which is how the interest rates are set. And a standard amortization, then the CMHC is simply upside, right? So in a competitive situation, I'll underwrite it on the assumption that I'm not going to get CMHC. And I could make assumptions about that, right? But I don't want my business case to rely on it. So then you'll still go ahead with the CMHC application and everything. Your business case just gets better if you have it. So it was 4 days on that. So we advanced our close on that purchase by about 2 months. And I wanted it because it was accretive. As I said, it was effectively a 6 cap based on rents that were 35% below market. So it was accretive to the portfolio, and I didn't want to wait. So we moved up the close by about 2 months. And then the big issue we had prior to close was insurance. So the age of the buildings, this is on the main street of Almont. And for people who don't know Almont, you'll know it for one of 2 reasons. The founder of basketball, James Naismith, right? That's his hometown. And actually his statue is right in front of one of these buildings, which is kind of cool. And then the other reason people might know it is anybody who's a Hallmark movie fan. A lot of Hallmark movies, especially Christmas movies, are shot in Almont on Mill Street because it's very picturesque. And these buildings are featured prominently in the background.
Cool. And then how far is Almont sort of like a suburb for Ottawa? Is that how it works economically, fundamentally, as an investment town?
Yeah, pretty much. I mean, Almont is a power generating town. There's a power station there right on the Mississippi River, and it's beautiful, very picturesque in that area with the waterfalls and so on. But it is fundamentally a suburb of Ottawa at this stage, just like Carleton Place is. So as you know, I live in downtown Ottawa. The Glebe to be precise, which is inside the canal limits. And I can get from my house to these properties in downtown Almont in about 35 minutes.
Not bad.
So they're close.
Ottawa doesn't seem like everything seems pretty close. Like what's downtown to the airport drive?
Oh, so
like I'm jealous.
Yeah, well, you'll be jealous because you live in Toronto, right, or
Yeah,
in the
that's
GTA.
ridiculousness.
So Ottawa is so Metro Ottawa, if you will. So I'm going to include Gatineau. That's about 1.5 million people. The Ottawa side is just over 1 million people. But the way the city's structured is it's structured along the river. That's the primary growth area, east and west. So you can go, edge to edge in Ottawa would take you just over an hour of driving with no traffic. North south is a lot faster. So the city's kind of long and skinny. So if you're downtown Ottawa out to the Ottawa airport, it's about 20 minutes, 20-minute drive. And it's a very scenic drive too. You'll just go up, if you're in downtown Ottawa, you'll just follow the Rideau Canal all the way up till you get to the Airport Parkway.
Should we just stay in the Glebe when we come visit?
There's no hotels in the Glebe. You'd
Nice.
have to stay in Centertown.
Okay.
That would be the closest and still be nice.
So you live somewhat close to where the protests were, somewhat close.
Oh, we could hear them. Yeah.
Oh wow!
Yeah.
Wait, hear what? I heard it's peaceful.
Yeah, sure.
Didn't you
So
hear?
I have a
They
bunch
all
of
said it was
buildings.
peaceful.
Yeah,
I saw the
I have
interviews.
a bunch of buildings in Centertown, right? So
Uh-huh.
I had to go and check on them. My tenants down there were a bit concerned. I'd say
Oh, they were
everything.
very close to it. Okay.
Oh yeah, yeah, yeah. My building. So you've got the Parliament District, right? Well, the Parliament Precinct, which is very narrow set of streets, and then you have Centertown, and then you have the Glebe. So that's the communities between Parliament and the Canal. And these protests were primarily on Wellington Street. And to be fair, it was reasonably peaceful on Wellington Street. I think it was just a big party that was going on that side. The issues that we were seeing were mostly off of Wellington Street. The biggest issue, well, there's two issues, I'd say. One was there were people that had air horns on their truck, and some of them were like effectively like a Via Rail train, horn going off, and that was really disruptive. You could hear that for many, many kilometers. But for the people that were literally living, within a block or two of that, those horns were going off regularly, like for about 20 minutes of every hour at all times of the day and the night. So that was, really problematic. And I think that was one of the key things that really upset people downtown. And then you get sort of secondary people who use any protest as cover. And it doesn't matter whether it's the trucker protest or any other type of
Yeah,
protest that we have.
G7, G20, they're just BLM. They're there to hide in the crowd and cause damage.
Yep, that's exactly right. So you had people who were certainly doing that, right? People who were trying to
Anarchists,
set fire
essentially.
to buildings
Yeah,
and stuff like that. But
yeah.
and then there was a little bit of harassment as well, which really didn't help. So, for example, there were people that be walking with masks on. So, waiters, for example, going to their shift, might have their masks on as they're walking to work, right, and be harassed about wearing their mask. And I think they were just intimidated more than anything. I'm not sure that there were many. There were some assaults that certainly made the news, but I don't think there was a ton of it going on. But it was just the whole environment just wasn't felt very peaceful, and I think a
Mm-hmm.
lot of people just didn't feel safe. But
Mm-hmm.
the air horns were the worst, honestly.
But they're peaceful. I'm sure. It's funny because I just issued an N5 for a tenant, and there's quiet enjoyment of property.
Yeah.
So I know what my tenant's opinion is of quiet enjoyment is. It seems all these people don't they believe that air horns are still considered peaceful.
Well, I was fantasizing about maybe taking an air horn on a vehicle and parking outside of one of their houses and just blasting the air horn at 1 a.m. and 2 a.m. and 3 a.m., etc.
Mhm,
Right? But
mhm.
we'll see how peaceful they think I am at that point.
Yeah, yeah. I don't get it. I don't get it. The whole peaceful thing. Like, I'll drop it after this point. But if my tenant was hearing that, they'd call me and say this is not peaceful, right? So it's not just me.
No, and we were dealing with that. I mean, we were getting calls. Most of it though is they recognize there's nothing we could do about it personally, but that we had tenants just making sure that security in our buildings was good, right?
Yeah, yeah,
Making
yeah.
sure doors properly latched, that our intercom systems were working properly,
Right,
and
right.
we have cameras on a lot of our buildings, right? So the tenants were thankful about that as well.
Mm-hmm.
And I had some inquiries of saying, these cameras work, right?
That's funny. They waited for this moment to actually ask if they work.
Yeah.
Oh, we were talking about this before we started recording. How to prepare for inflation.
Oh boy.
And you're smart, so like I like asking you because I'm crazy. I have all these crazy ideas. I dabble in some Bitcoin.
It's funny because as I was saying to some people, when it comes to predictions around anything in the economy, even the best of us, I think, are only a little more accurate than random chance.
Mm-hmm.
The economy is just so complicated. There's
Right,
so
right.
many moving parts, and for us to oversimplify it, I think is just a mistake. We can see the effects of supply chain. We know what that's doing in terms of driving inflation right now, which is interesting. Because I think most economists would tell you that in a real GDP sense, the economy is probably going to grow by about 2% this year, and we're running at about 2%. But I don't think they've taken into account all the inflation that we're actually seeing, because you can see where we're completely blowing the doors off of the actual inflation rate versus what the predictions were,
Mm-hmm.
which leads you to believe then that the real GDP may actually be in a contraction period. We may not actually see 2% growth this year. We might actually see a contraction.
It's so weird though. Anyone who wants a job has a job, it seems, or anyone
They
who wants.
do.
Yeah.
But on the demand side of it, and that's always the thing, right? When we're talking about inflation, is what's driving it. Classically, in the past, it was demand side inflation, and that results certainly in wage increases, et cetera. Back in the 70s, it was averaging about 5% inflation over that period of time. Now we're seeing it's more like about in terms of GDP growth. Sorry, that wasn't inflation of 5%. That was GDP growth. So now our GDP growth is nominally 2%, but our inflation rate is really very high.
I think March was 6.7%,
Yeah.
and that was the biggest factor was gas prices.
Yeah, absolutely. But it points to the fact that inflation is supply chain driven, right? And it's supply side as opposed to demand side, which is why a lot of people and a lot of economists think it's going to be transient in nature. And I really hope it will. And my suspicion is it probably will. And then I think we're going to get into a very confused state with the Bank of Canada and and the U.S. Central Bank as well, and Bank of England, because they're going to have this quandary. You've got inflation going in one direction, which they feel they have to address, and they've already announced, lots of rate increases, and we've seen the bond market respond over the last, month and a half as well, where you see rates anywhere up to 5 years went up very quickly. So you've got that on that side, but if the real GDP is actually contracting, then the government is going to start to think carefully about, well, are we moving into a recession, right? And this is sort of a classic stagflation type situation. So now you got to think, okay, what's the central bank going to be doing in this type of environment? Are they going to prioritize inflation, or are they going to prioritize, economic growth? Right. And I think in the end, they're going to cave and they're going to support economic growth, which means then that interest rates would be probably coming back down, towards the end of the year. And we were talking about the supply chain issues earlier. You've pinned one, which is oil, right? Everything is driven by energy. Energy is an input to just about everything that we do. So if energy costs go up, it doesn't matter what part of the economy you're looking at, it's dependent on energy, right? Even food is a big issue, right? Because energy goes into the production of food, everything from fertilizer to harvesting. And we've seen lots of increases on that side of it. You and I were talking a little bit before our session here, and one thing that I just came to realize more recently was the dominance that Canada has in potash. We have probably about 40% of the world's supply. I would guess it's about 15 million metric tons. But the second biggest producer of potash in the world is Russia with Belarus. And that's about, so Canada's about 14 million metric tons. Russia is about 15 million metric tons, right? Russia and Belarus. And of course, with the sanctions, that supply is kind of held off. And to put it into context, the third largest producer of potash is China with about 5 million metric tons. So we're effectively cutting off about 40% of the potash supply. And that is going to have secondary effects, I think, towards the back end of this year. So you've got energy on one side, right? And then we've got the sanctions that are happening in Russia and the Ukraine. And if those don't lift in a reasonable amount of time, then we're going to start to see impacts on food supply as well. So all this stuff is just going to make for some really turbulent times coming up over the next couple of years at least. Where the bank is going to be a bit confused about which way to do things. But I think at the end of the day, they're going to double down on getting the economy, right and stable, even at the risk that inflation may continue on. Sorry about that.
Yeah, to add to that, with all this new spending that's in the federal budget and our provincial budget, they need cheap interest rates.
Well, yeah, but so, some would argue that the federal government should have backed off on a lot of that stimulus, as early as the middle of 2021. And I would tend to agree with that. And it's kind of weird because you've got the Bank of Canada, of course, increasing inflation, right? But then at the same time, you've got the federal government in particular putting more money into the economy, which of course helps to fuel inflation. So they're kind of fighting a little bit against each other. So, and then you saw too, right? Everybody thinks about the Bank of Canada and the overnight rate and how that's going to affect the variable rate. But the other thing that the Bank of Canada did at the same time with that announcement is they shifted from quantitative easing to quantitative tightening. And that basically means, where the quantitative easing, some people would just think of it as printing money, right? Which it sort of is, but really isn't. Quantitative tightening is effectively not renewing the bonds that they did buy at that period of time, which means that there's going to be some upward pressure on the bond market. It has an indirect effect of, affecting the, fixed rates, if you will, because it affects the bond markets, the yields go up. And that's one of the reasons that I think we saw the short-term yields go up and why fixed rates went up recently.
Yeah, we're probably seeing, I see it on Twitter. I think we're probably going to see like 4.5 soon on the 5-year fixed.
It wouldn't surprise me. I locked in that portfolio that I bought in Almont. I was actually getting a bit nervous about it because my underwriting at the time with CMHC required me to have a total interest rate of no higher than 3.45. And when I first started this, it wasn't really much of a risk. I think my interest was going to end up being around 2.5%. And then when Russia invaded the Ukraine, there was actually a demand in the bond market, which resulted in a drop in the yield. So my interest rates actually dropped by a quarter point. And I thought, okay, well, at least I might be able to get, some advantage out of this situation. But then within about a week or two, it went the other way, right? And then people got nervous and in terms of what it was going to do in terms of inflation in the economy. And then the yields started going up. And then when the Bank of Canada added fuel to the fire, it didn't help. So I ended up having to do a buy down on the interest rate in order to guarantee the interest rate at 3.45, but I had to put money into it at the close in order to get that done.
As a percentage, how much more did you put in?
It wasn't much. It was about 1%, right, of the total loan value. But it was, that was where the spread difference was about 0.12. Right, between what I was contracted with CMHC versus what the bond yields actually were. So for people who aren't familiar with this, it's when you get an underwriting with, say, CMHC, and they say that they're going to guarantee the underwriting or the insurance for your loan up until you get to a certain interest rates. But when you're doing a commercial fixed rate, it's not something you can pre-negotiate. You can negotiate the spread, but it is completely dependent on when you buy the bond in the bond market. And so if the bond yields are going up, then that affects what your interest rates are going to be. So usually, about a week ahead, or even sometimes a day or two ahead of the actual close on the purchase, you have to do what's called a rate lock. And the rate lock is basically where the lender goes to the bond market, buys the underlying bond, and then you've got that particular yield. And if anybody's ever been through this, it's about a 7 to 10 minute window. So they literally say you have to be on standby. So what they're going to do is go to the bond market. They get a quote that's live for 10 minutes. So you have to confirm whether you're going to accept that particular interest rate. And you've got, by the time it gets to you, you literally have 5 to 7 minutes to make that final decision. So it's an interesting process. And then once that rate lock is in, you're done. And
So,
you
so
have
Christian,
to
is this like a Zoom call? Like what? Or you actually you're together on the floor, the trading floor?
No, it's done via email, right? But they basically it's literally done by email, but you're on standby. You're sitting there, they say, look, we're going to go to the bond market at 10:30 a.m. Make sure, because we're going to have probably about 7 minutes for you to confirm in total.
Fascinating. Wow. What
And
was
you
it like
have
the first time you did this? This has to be able to, like, I don't like that one. Throw it back. Don't catch me out of a bond.
Well, you can do that actually. So you can go and you say, no, I don't want that, right? But most of the time, things are not so volatile. What you're getting is the rate for the day, right? And it might go up through the afternoon, but if you don't like that one, they'll probably just go back to the market the next day. But usually what you're hard pressed against is your close date. So your close date, it's hard to move in a lot of cases. And then you have at most, in most cases, 10 days before the close date where you can do your rate lock. But you don't want to eat up that buffer, because there's the other side of it, which is, let's say I do a rate lock 10 days before my close. I have to now close on that date. If I don't close on that date, I have to start doing buy downs on that bond. So it costs me it costs a lot of money. Think of like 1% per day kind of penalties associated with that.
So, who walked you through this process the first time?
Oh, I was totally naive the first time. I had
Fun.
no
That's the best way to do it, right?
I was just on a roller coaster ride the first time. I had no idea what was going on. So,
Sit by your email. Okay.
yeah, to be fair, the lenders are really very good at managing all of this. So it's not like I'm trying to orchestrate. The lenders just tell me what's happening. And like I said, the bond yield rates, they don't fluctuate that much in a day. Recently I've seen them fluctuate by a full quarter point, but most times they don't. Most of the times they're really pretty stable, and they'll fluctuate by, maybe 5 or 10 basis point at the very, very most. So it's not it's not that unnerving, but it was unnerving this time only because the bond yields were actually fluctuating. Well, when I say fluctuating, they were going up, and they were going up fast, and you'd see like quarter point jumps easily each day.
Right. And then yeah.
So yeah, so it's not a pretty process when the markets are really volatile, but the vast majority of situations, because I really don't want to scare people either, right? It's just the vast majority of situations, and I would say literally every other deal besides this one, it's a very simple, normal process. You'll do your rate lock, everything's going to go fine, and you're really not going to worry about it. But this time it was a bit harrowing, just because the yields had gone up by almost 2 full points, right, in the span of a few weeks.
And then Christian, you just have like piles of cash waiting around for when deals are available.
So what I did in this case was I was starting to stockpile cash because I've got a major repositioning project I'm doing. So I've set aside credit, I've set aside cash, I've got refinances that are happening all the time. So all this cash was just kind of coming in.
That's
So
yours. Is it you have other partners involved or?
no, this is just our money. We don't take external investors. So we don't take external equity investors at all. But we've got enough of a portfolio now that there's always a refinance going on some property. So we're extracting new capital all the time that we can use towards new projects. So a good chunk of this was capital that was going towards a repositioning project that I have. And but this deal was just too good to pass up. It was highly accretive to the portfolio. I mean, we advanced the close, I think I mentioned, by 2 months, and the reason was that it adds cash flow to our portfolio as soon as we close, and it was substantial cash flow. So you don't want to pass those things up, and so I didn't. And but we have probably, I think, 3 or 4 other refis coming up at the back end of this year, where we'll be able to take out more cash for projects that we have on the go. So we kind of entered this discussion, I think, a little bit about what's happening with the economy and
actually, more specific, more about what are you planning to do with inflation? Oh, and actually, I had a comment to make. I totally agree with your point. No one really knows the idea where the economy is going. One thing we can predict is the central banks will, in generally, there will be more money supply. That's what I predict.
I think you're absolutely right, and that's kind of where I was going before. When if the bank decides to prioritize the economy over fighting inflation, we're going to see loosening. Things like quantitative easing is going to start to happen again, which kind of increases the money supply. Interest rates will probably come back down, or at least be moderated. So that stuff can all happen, but what I don't do is rely on that, right? Because I just don't know what's going to happen. There might be another war. There might be, God forbid, another pandemic, right? Anything can happen, and you just don't know. So I really look at things on a risk managed basis. So I take a look. Is everything okay over there?
Hopefully. You can still see me?
Yeah. You're fine. So I look at things on a risk managed basis. And when I take a look at things like interest rates, inflation is something that I kind of like, in the context if it makes my debt cheaper, right? And that's the way I look at it. I don't think about it as, it makes my assets worth more, because there's nothing that's fundamentally changed about the assets. Their intrinsic value is the same. The only thing that changed was the value of the currency that you use to buy it. But my debt is tied to that currency. So with rapid inflation, so for example, 6.7%, year over year inflation you were talking about earlier. Well, my debt just got cheaper by probably about 6% as a result. So that's great, right? Now, the side effect, of course, is interest rates. And that's where you need to decide how are you going to mitigate that particular risk. So a lot of people are into variable rates. I have no issue with variable rates. And if you believe that you can weather an interest rate storm, right, in that, then variable rates probably make the most sense for a lot of reasons. But in my business, there's such a huge debt and asset value that a significant fluctuation in the interest rates could affect my operational budget. So I like to have predictability on that. And so for me, I look more at fixed rates that match the duration of a particular project or objective. And it's not unusual for even my larger competitors, if you will, some of the bigger companies like Hazelview or Minto or Homestead, they won't even look at just a 5-year lock. They'll be looking at a 7 or even a 10, depending on how much they need to weather a particular storm. So in my view, predictability of cash flow trumps any potential gain I might have from a variable rate. Now, there is the other thing too, that when you're dealing with commercial loans, almost every product is a fixed rate because it goes to the bond market. So it's not like, I have to make a lot of these hard decisions, but some of my smaller mortgages have a choice of being between variable and fixed. So I run it at about a ratio of I would say 75% of my mortgages are fixed products, and then the rest are some form of variable, whether it's line of credit or traditional variable type mortgages.
And then how do you hedge for like all the renovations that you have planned? Because that's I was talking to my handyman just on Friday,
Yeah.
and he was telling me he couldn't find any ABS plumbing materials. He
Yeah.
went to like 6 different retail stores like Home Depot, Lowe's.
Yeah.
No
And
ABS.
you have to buy, you have to buy well ahead on a lot of these things. So we've always had a process when we're doing our renovation projects, or more specifically in the repositioning projects. We know the timeline that that's going to work to, and then what we've typically done is buy the supplies when they're discounted. So if we know that we're going to be doing, full electrical overhaul of the building, or we're doing a lot of plumbing work, or we're going to be buying, doing hardware floors or HVAC systems, then when there's a price break, we'll buy it and we'll store it. So that's the way we typically deal with it.
Mhm.
And certainly for retail stuff, you just watch for discounts every once in a while. So everybody's got a discount maybe once a quarter or once every 6 months, where you might be able to get like a 20 or 30% discount on something. Or
And you're
there's,
storing it?
yeah, we store it. So we'll pay for the storage cost, right? But that's, it's a lot less than if we have to buy it on demand. But right now, like I'm looking at heat pumps on a repositioning project, that's a 12 unit building that we're doing. It's a conversion of a 7 unit to a 12 unit building. And my HVAC guys told me that they need about 6 to 7 months lead time to guarantee that they'll have the equipment.
Does that
So
does that timeline work for you?
yeah, it does, because I'm in site plan control, and
Right, right,
yeah, and the city, right? It'll
right, right.
probably take 6 to 7 months. So as soon as my site plan, I get a thumbs up that it's going to go through the process. So I'm just waiting for feedback on that. As soon as I get the thumbs up on that, we'll put the order in for the equipment. So we'll have to pre-buy all that stuff.
Well, what about the properties in Elmont? Like, uh,
Mhm.
don't those renos need to be done sooner than later?
Well, we have to wait for tenant turnover, right? So we store stuff
Oh,
like,
sorry, apologies, because you mentioned like about a quarter of them need to go back to the stud. There's
oh
people
yeah,
living there.
yeah, yeah.
Okay, got
It
it.
do, but I don't know when the tenants are going to move out. But some of the harder things to get are appliances, for example. So we've been hoarding appliances. We usually buy them on the secondhand market anyway. So when we see stuff that we think we might need, we literally just go buy it, pick it up, and we store it, right? So
Got it.
literally, when somebody needs a new stove or a new fridge, right, we get one to them the same day. We don't go out and try to source it and buy it. We
Got it.
literally have them on hand.
Christian, for the novice, can you explain? Like, do you have staff, or are you going out there with you and your wife are going out there with a truck and picking up stoves and washers and
I'm getting too old for this shit. My wife still tries to get me to try and move a stove, and I will in a pinch, right? But I don't want to be lugging these things upstairs. I'm just not built for this
uh-huh,
anymore.
uh-huh.
No, so we have people that'll do that, and we do have some amount of staff, although it's been a bit more challenging through the pandemic. But then we also have subs as well, so we've got a team of people that'll do stuff like that for
Got it.
us.
Got it. Can you share how many staff you have?
Yeah, sure. We have 5 people all told, combination of T4 and T4As.
Got it.
Yeah,
And
and then
then
we
what are-
do,
what
and
are,
then we get subs as well. So
again for the more novice, like what was your recommended first? What would you recommend to be your first hire?
oh, bookkeeper.
Bookkeeper.
Yeah.
And then after that,
Um,
sorry, when you say bookkeeper, are they T4 or are they subcontract?
no,
Is
they're sub.
yeah,
They're sub.
yeah.
Yeah, especially when you're first starting out, right? But that's a mistake I think a lot of people make right off the bat, is you really do need a bookkeeper to keep your books straight, because
Uh-huh.
most people really don't know how to do their books properly. I think I know what I'm doing with the books, but even I won't touch them, right? My bookkeeper's still 10 times better than I'll ever be and much more efficient. And it sure makes tax time a lot less expensive.
My wife appreciates those things. And then,
Yeah.
sorry, could you go through the what positions do you hire for versus which ones do you sub out?
Depends what you're doing, really, but I would definitely get a somebody who can do some basic maintenance, right? Not necessarily a full handyman, but you're going to need yard work done. You're going to need someone to take out the garbage. You're going to need somebody who can do some basic painting and drywall repairs. So we have a maintenance guy that does all of that stuff for us. And then we also have a, we call him, we kind of refer to him as a handyman, but he's really a builder, right? So he's a builder. He does framing. He can basically do everything. He's a bit of a jack of all trades. And he literally moves from renovation project to renovation project. And then they supplement. So when we're doing a full repositioning, though, we're going to hire out a crew for that. We'll supervise the crew, right? But we'll have somebody who acts as a foreman. They'll be under contract for that period of time. And we'll bring in people that we need. Our plumber is a contractor. They're always handy to have. I can do plumbing. I can do a lot of things, right? But I don't really want to do it.
It's a shitty job. Sorry.
Yeah, literally at times. Yeah. But it's funny that our plumber, he only does work for us, and his main gig is actually real estate. So he's a real estate entrepreneur now. He also has an appliance rental business. And he's just a natural entrepreneur, but he still likes to do the plumbing, and he only does the plumbing for himself and for us.
Cool. And he can fix appliances?
No, he doesn't fix the appliances.
Oh, okay.
He has an appliance rental business. So in Quebec, it's typical that you get an apartment that doesn't have appliances. That's the norm. And so it's quite an industry on that side where there's appliance rental business. So tenants can either buy their appliance or they can rent their appliances. And so he has a business that literally just does that. But for the rental appliance business, his MO on that is he'll buy new appliances, he'll put them in. And then when they come off rental, he just sell them on the used market. He doesn't try and redeploy them at all. And then he just buys more new stuff.
Cool gig.
Yeah, well, the markets are all really dynamic, right?
Christian, could you share at what point do you go to outsourcing to a crew? Again, not everyone. What I forget what the term you used was projection. Never mind. At what point does the
repositioning? You mean?
Repositioning? Yeah.
Oh, okay. Yeah, so it'll completely depend on the nature of the project, right? So normally what you want is for T4 staff, it's where you've got a very steady amount of work, right? So if you've got
routine,
work that's just routine, for the next few years, you're always going to have this kind of work. You might as well hire them on as T4.
Right.
If you've got work that can fluctuate, right? So you might have demand in 1 year, but it may not be there the next year. Then you want temporary staff that fall under a T4A. They're still contractors, if you will, but they really just work for you or predominantly for you. And so you're supposed to give them effectively a T4A. So it gives you a bit of flex. And then you'll have also, subcontractors, which are job specific contractors, and, they're invoicing you, that kind of thing. So that's sort of a third tier. So when it comes to that third tier, it's literally project by project for me. So we don't do secondary suites, but a lot of your listeners will do secondary suites. And if you're doing a single secondary suite, you're going to get a bunch of quotes from a bunch of different contractors in terms of how it's going to get done. And then you're going to pay them a contracted price, or you could go time and materials as well. But it's going to be for a fixed period of time, and the project's done, and they move on and they go do another job somewhere else. So our projects are similar, they're just bigger, right? So we're doing a 12-unit repositioning project. So in that case, we're going to have to hire a crew of people, right, to do the work. And it's always an interesting discussion with my accountant, right? Because on one side, you could just say they're regular contractors. In other cases, you do have to issue them T4As, depending on the nature of the relationship, right? And, Cherry would be a better person to speak to that than me. But depending on the nature of the relationship, right, again, it's, and almost irrespective of the nature of the relationship, it just allows you to flex. So I'm not constantly doing repositioning projects. I have them, they get done, right? And then I might have another one like a year later, right? Or 6 months later, or 2 years later. So I'll just take a crew on specifically to do that. And then when they're done, they move on to their other projects.
I don't know, Christian. Sounds like you're pretty busy.
Well, that's why we have a builder on staff, right? So we can keep him busy.
One builder.
Yeah.
But your projects, you've taken on a couple of disaster projects.
We do, but like I said, a lot of those disaster projects. So the builder basically.
Apologies, they're a disaster before you set foot on them. It's not that you created the disaster. Oh, just to clarify.
We could do like an HGTV show on this kind of stuff, but I've certainly talked about them before, so we won't recap them here.
Yeah. Oh, but for folks who didn't listen to Christian when he was on previous episodes, the last one in September, some crazy stories with break-ins and cops and cameras and.
Yep. Yeah,
cops leading to evictions, and it's actually a great argument for why you need tech in your buildings. Yeah. Sorry, Christian, continue.
2 podcasts ago, I think we talked about one of my buildings had all kinds of problems. It was an acquisition where it was basically a 10-unit building where we had 2 hoarders, we had a drug dealer, we had a guy that just liked to beat other people up. We had 1 good tenant and 3 vacant units. And that building is beautiful now. It's performing incredibly well. But the reason we have a builder on staff is he's typically doing all the turnovers, right? So he's more of a jack of all trades. He can do everything. So when we have a unit that needs refreshing, he'll do that. He'll take it all the way back to the studs if that's what's required. And then when we're doing a repositioning project, that's typically a different crew that we'll hire out. So he's not tied to that. Or if we have peak demand work, then we'll just add contractors into the mix, right? So we did one of our office buildings with, there's obvious issues with respect to renting out larger square footage of space for office use during the pandemic. So we completely reconfigured them into individual offices and rented those out. Increased the revenue by worked out to roughly 50% increase in the revenue per square foot for the same space. But in order to do that, we have to hire a crew in to come in, rebuild all this stuff, right? So you're often flexing up and down on these types of projects.
And then you need, before we're recording, even though you're improving these properties a lot, some of you have 3 vacant units in a very, I'm sure you have a housing crisis in Ottawa as well, and you're saying you had a building with 3 vacant units. I'm guessing there was something wrong with the building.
Oh, that was the building. We talked about that in a former podcast, I think, but we did that acquisition back in 2017.
Right. But even your current downtown property that you bought, it's hard to track all these things.
Yeah. So we bought a 7-unit roughly a year ago. That project, we're repositioning the building into a 12-unit building.
Could you try to paint us a picture what the 7-unit building is like? Is it like a 3-story, 4-story? Is it purpose built? What does it look like?
Yeah, it's in center town, so it's right downtown Ottawa. It's in a premier area, if you will. But this building was built in 1901, and
century home.
Exactly. Now, interestingly, it's just outside the Heritage Overlay District, so I don't have heritage requirements, but I'm making it as part of my proposition for site plan control that we're going to beautify the building and preserve the heritage nonetheless. I'm doing that because I need a favor, right? I need some concessions from them. So
They'll play ball. They will. Like this is
yeah,
they will negotiate on stuff like this.
yeah, yeah. They're not unreasonable. I think the city gets a bad rap half the time. I usually find that they are willing um, to be reasonable about things like this. But on something like this, another building which I never told you about, we have another Centertown building that I was at Heritage Committee a few weeks ago, pleasantly surprised that as part of the heritage strategy, as a secondary effect of the new official plan, they featured two of our properties as examples of what developers should be doing to preserve heritage within the Centertown district. And we had two counselors, including a counselor I'm going to need support from for my new project. She was on the call as well. And it was kind of I had to call it out, and as well, I really thank you very much. I appreciate the fact that you featured a couple of our buildings. So in the site plan control, I'm just referring back to that as well, right? And so my going in compromise, if you will, is to look, I'm going to do this because we like beautiful buildings. Okay, I'll be perfectly honest. So we're not beautifying these buildings because the city's making us do it, right? The city will give us incentives to do it, but we like to be proud of the buildings that we own, right? And so with this building, the one that I'm talking about, the 7-unit that we're going to convert to 12, it has a lot of heritage value and can add a lot of character. And the rest of the street has beautiful homes. They're period homes, but the owners have all lovingly restored most of them, right? So it's really very nice. So that's what we're going to do with this building. So it is a 3-story building. It's in what's called an R4 UD zone, which gives us an awful lot of latitude in terms of what we can do, even including height. So you have to respect things like transition between houses or between buildings. You need to respect what's called massing as well. So how much of a presence it has on the street. And then the city basically asked us to do other things. I said, well, can you do something to prevent tenants from parking on the front lawn? Right. I said, yeah, we'll put that design feature in. That's fine.
So
Can you
what would that be? Like rocks or like a fence or?
No, what we typically do in our properties is we'll put some sort of artwork in the front. So we'll create some sort of stonework from a perimeter, and we'll create sort of a nicely landscaped interior to it, and then we put some amount of artwork in the front as well.
Is there an address you can share as I can do a Google Street View?
Sure. I'll give you 2 addresses if you want to take a look at that. So one of the properties that was featured in the Centertown Heritage Plan is 314 Frank Street in Ottawa. And even if you do it street view, I think it's fairly current in terms of what it looks like. And then an example of artwork that we also did was, this was a project we did back a few years ago on 442 McLeod Street. And that's a 6-plex, so it's a little one. But you'll get an idea of the kind of artwork that we might put there.
Right. Frank Street looks a little overgrown. This might have been why you were transitioning it. That's a nice looking building.
It's a beautiful building. You'll take a look at the all of the detailing on the front. We restored all of that millwork.
Wow. That doesn't look cheap, and I don't really see much of this stuff.
I'll send you some pictures of what the gardens look like, because the gardens are absolutely beautiful.
Are they on your Instagram?
They're on our Instagram, and they'll also be on our Facebook page. If people go to Aliferous Group on Facebook, you'll certainly see all the pictures there. We post them regularly.
So do the city people like you? They don't like most landlords. Well, not in my experience.
Well, like is a relative term. So,
oh, McLeod, look at that. Oh, wow. Yeah. Hopefully no one parks on that.
No, it would be painful for their vehicle if they did.
Oh, yeah. That's by design, right?
Exactly. So that's the kind of stuff that they ask us to do. So say, yeah, that's no problem. So we put that into our design. So we kind of show that we're compromising. So what ends up happening behind the scenes in a site plan control or later on in the committee of adjustments, if anybody's ever been to a committee of adjustments, it's basically set up where the committee is an elected committee. And then you go in to put your case forward. And if somebody wants to oppose it, they can come and give a counterpoint to the committee to say why you shouldn't get those variances. But before all that happens, they also look to city staff to say, what their opinion is. And so if you work well with the city staff and you've shown that you're willing to accommodate what they want and you're not trying to just bully everything the way you want, then the city staff will say, look, we support what they're doing. They've done everything they can in order to not ask for these kinds of variances, and they've made concessions in other areas in order to enable this. Then you've got the backing of city staff, which helps. And then the other thing we do with things like committee of adjustment is I'll shop these plans to the neighbors. The 10 closest neighbors, I'll just shop it with them. And I will also shop it to key influencers on the street and tell them what the project is about, why it's going to enhance the neighborhood. And I'll ask them to sign off on a letter of support. And then I submit those letters of support with my application in the committee of adjustments. And it usually turns into a non-event. And I kind of, in one scenario, we had someone who was objecting, right? And that took a little bit more time in the committee of adjustments. But in that scenario, because we had overwhelming support, the committee of adjustments went in our favor without having to go to an appeal.
Yeah, we're in Hamilton, we have overwhelming unsupport of our garden suites.
Different projects have different acceptance by the community. I kind of look at it as a democracy, if you will. So if I'm putting in a project into a neighborhood that doesn't really fit the character of the neighborhood and isn't going to garner support of the neighbors, then I probably wouldn't go ahead with it anyway.
Right. Well, with Frank Street and McLeod Street, for example, did you reposition them? Did you add suites? Did you add stories, additions, anything like that?
Yeah, Frank Street was easy. So Frank Street, that was how many units was it at the time? It was a 6-unit building.
Really? Can't tell from the front. Can't tell from looking at the front.
No, it was originally.
Oh no, sorry, Frank Street. You can tell. Yeah. Frank Street was big.
Frank Street was a 6-unit building that we converted to 9. Okay, and we did that back probably about 7 years ago.
Okay, where did the extra units come from?
That's a great idea. Did you just
put up walls? Or...
Kinda, yeah. We had, on the second floor, there was a very large 3-bedroom unit. It had 2 bathrooms in it already. And it was, the previous owner was living there. So it was very spacious. And renting out 3-bedroom apartments is actually pretty tough.
No kidding.
It is. So,
it's uncommon.
Well, the city would say they'd like to have families move in there, but in our experience, I'd say 25% of the time it was families. And then the other times it was people who, usually students who wanted to rent an apartment, and then each of them would use a bedroom. So we didn't really want to do it as student housing. And then the other issue was that the revenue per square foot of a 3-bedroom is a lot less than the revenue per square foot of a 1-bedroom. So what we did was we took that unit and we split it in half, created 2 very nice luxury 1-bedroom units. But even on, as is basis, the revenue per square foot went up by about 50% right off the bat for that same floor space. And then there was unused room in the basement. So we expanded there and we added 2 new basement micro suites in there.
The previous owner just left unused space?
He did, because there's another problem. In Ontario, if you go above 6 units, then you get into the MER tax rate, the mill rate there. And the mill rate in Ottawa, so residential mill rate is about 1.0, 1.05, somewhere around there. But as soon as you go above 6 units into your 7th unit, you're now in the MER class. And that MER class has a mill rate of about 1.4. So your taxes go up about 40%. Your property taxes go up by 40% by adding a 7th unit. So that's where I say, like, if you're going to redevelop or reposition a product like that, and you're going to take it above 6 units. Units 7 and 8 is kind of the valley of death, right? Like there's literally no point to do it because you add that 7th unit and all the revenue you get from it just goes to pay property taxes, or most of it. So, and then the city wonders, why don't we have more people doing 7 and adding a couple more units on these 6plexes? Like you guys talk, basically you're telling us through the tax system not to do it.
Yes.
So that's why you need to really jump to about 10 units before the business case starts to hold together. And some would suggest up to 12 units.
Fascinating.
And so the McLeod Street property that I showed you there, that one was originally a triplex. And we did talk about this in a previous show, so I won't get into the details on that one, but that was a troubled building, but it had a lot of square footage space on it. And we turned it from a triplex with 1 illegal unit and converted it to a 6plex, a modern 6plex. So that's a beautiful building.
Man, I hope there's time to see some of these places when I come visit you.
Oh yeah, for sure. Yeah, we'll do that. We'll go take a look at least some of the Ottawa properties for sure.
All right, we still have to talk about that. Actually, no. Yeah. So June 8th, we'll come in to visit you. I can share? Charlie will be speaking at Oreo.
Yeah. Yeah, we're going to have June 8th at Oreo, 7 p.m. So we're going to have both Cherry Chan, and that's Irwin's better half, and Elizabeth Kelly will be there as well. So we're going to have both of them speaking that evening.
Fantastic. And Oreo is the largest real estate organization in Ottawa, is it not?
Yeah, it's we refer to it as a club, but it's it's the largest of the organizations and the most active, certainly within the city. We have about 400 full-time members, and they don't all show up to all the meetings, but they're always there. And we've also done an association with the Eastern Ontario's landlord organization, which represents all landlords. And what we did there was an alliance where they do our lobbying. So particularly with the municipal governments. We've had some great outcomes on that side, which we can certainly talk about as well.
Yeah, we're running out of time on that part.
But on the Oreo piece, though, we went back to live and hybrid 2 meetings ago, starting in March. So we do our meetings in person at the Infinity Center, and then we also remote members or members that aren't quite comfortable coming in person yet can come in through Zoom, and it's an interactive discussion. So people on Zoom can still participate with what's going on stage as well, and Q&As still work, etc. And members that are presenting while they're on Zoom calls, it's all seen from within the Infinity Center. So it's a real cool setup that we've got on the go. So we're still going through a few teething pains on it, but it's pretty neat.
Where can people find out more about Oreo? And
if you want to attend the event? Is to go to our website, Oreo.org. So that's spelled Ottawa Real Estate Investors Organization. So OREIO.org. And they can always reach out to me if they get lost.
And where can they reach you?
You can reach me any number of ways. Christian Szpilfogel on Facebook is an easy way, or via email, Christian at.
Oh, I'm going to pause you there. This is internet. This is for life. You sure you want to share your email?
Well,
maybe your website and a contact us page.
I don't know. I don't get too much spam. The most spam I get these days is purely from people trying to tell me why I should be trading Bitcoin. So.
Trading Bitcoin. Do you do any Bitcoin? Any gold, silver, Bitcoin?
I don't. I focus on real estate, and a discussion we had earlier. We were talking about the economy. Is that the punchline through that whole thing is the smart money right now is putting their money in hard assets, right? Whether it's real estate, whether it's certain precious metals. I've seen Bitcoin now described as a hard asset, although I'm still struggling to get my head around that. But trust me, I'm a technology guy. Okay, so I'm not shying away from Bitcoin because I don't fully understand it. I think it's an interesting area to investigate, right? But it's not the technology that scares me.
Well, what are your friends from the tech world saying? Like, are they divided?
Uh, yeah, I'd say that tech investors, so people who are technology background and are investors, most of them, I would say, have thought about Bitcoin more in the context of experimental and a hobby, and not necessarily as a serious investment vehicle. Okay. And I'll admit, I do get worried when everybody is talking about any specific investment class. When I go and get my hair cut, right, and the barber is talking to me about Bitcoin and how he's trading, when the Uber driver starts talking to me about Bitcoin trading, when I get approached endlessly on Facebook with people who want to be my friends, but only really just want to sell me Bitcoin trading stuff, I get nervous about that. It makes me think that there's something not quite right.
Right. Not, they're all trading. None of them are holding.
No, they're trading. People are trading. That's what I'm
Okay.
typically seeing. People aren't necessarily holding, they're trading. Even my 86-year-old father was asking me, how do I get into Bitcoin? Okay. And so I said, well, Dad, is this just for play money? Right? Or are you doing serious investing? Because I think you really need to do a lot of studying on this. But if you just want to, if it's play money and you don't mind losing it, that's fine. Right? I can help you out with it. But that's kind of where it stopped.
It's
But
funny because
add
do
that
you remember any time
barbers.
people talked about trading gold?
Well, exactly. And I think that's because a lot of people don't fundamentally understand what crypto really is. And when we take a look at something like Bitcoin, to me, the equivalency is gold. It's a storage of value, right? But what a lot of people are doing is
Hopefully.
they're well, who knows, right?
Yeah, who knows?
Yeah, there's a lot of speculation as to where they think it can go, but it's just that speculation. But what a lot of people are doing is trading on the volatility, right? And just like people do in the stock market, they're technical traders. So there's that piece going on. Ethereum is really kind of interesting because it's more of a platform where other things can be built on top. So I'm kind of curious to see the companies and the business opportunities that emerge on that platform, because that could be interesting. But personally, I prefer assets that generate some form of a dividend, right? Real estate is a great way to do it. And when we talked about earlier, it's effectively a storage of value in inflationary times. It's one of your best hedges for sure, because regardless of what the market does, you're still getting an income stream out of it.
Yeah, if the price of 2x4s go up, I got lots of 2x4s in my house, so my house is automatically worth more, right? So hopefully no one goes breaks into my house and steals my 2x4s.
Yeah. Well, you just go back one podcast to hear about those stories.
I need cameras.
It's not the 2x4s, it's the copper. Yeah.
There's not enough copper on my properties to steal. Hopefully, not knock on wood.
Just hope they
Christian,
don't go into the walls.
thankfully, all my places are all tenanted, so hopefully they'll defend my copper. Christian, this has been a blast. I know we could go on for another hour or three. Thank you so much for your time. Any final words you want to share? Could you imagine if people are still not convinced to own hard assets?
No, I mean, this it's become so obvious after a while, right? And sometimes I think it takes wisdom of time, right, to kind of be able to see the history for yourself.
Right.
I got into real estate in 2005, and in terms of picking up rental assets, if you will, right? Obviously, I had my house. I had done some land stuff before that, but it was never really serious. And now I look back and think I really should have started a lot earlier, because at the end of the day, they're not making any more land. Cities are still continuously growing. Rural to urban migration is a real thing. And that even if you're not in a high growth area, at the very least, it's a storage of value that generates cash for you. So it's an asset class that I think everybody needs to hold. And the only recommendation beyond that is that I think people shouldn't just buy willy-nilly. I think people really do need to get some level of training, some level of education, maybe some level of coaching or mentoring, to make sure that they go about it in the right way. But it's one of those asset classes that even if you do the wrong thing, time will forgive it, right? Time cures a lot of mistakes in real estate.
But time for the central banks to create more money.
As they create more money, yeah, it really, and I will say it again, when they start printing money, your debt fundamentally gets cheaper. Protect yourself against the interest rate hikes, if that's what you feel you need to do, but your debt gets cheaper relative to the asset itself.
And at the same time, your savings go down in value.
That's right.
Your cash savings.
Yeah. Only hold the cash you need for reserves, right? And if you can hold it as credit, that's better. Yeah, I mean, just think about the price of the house that your parents bought.
Oh my God.
Right? What did they pay? What was their loan value? Right? And if you just did it as an interest-only loan from that period of time, so won't talk about the cumulative carrying costs, but if you had to pay off that mortgage now, you'd be whipping out your Visa card.
Yeah, it's ridiculous.
Well, I don't know. My parents bought in the 60s, so they would be whipping out a Visa card.
Yeah, not mine. My parents had 3 mortgages on their first house. It wouldn't be quite my Visa card. Maybe all my credit cards. But yeah. But yeah, it's a pretty insane thing to think about. And then you'd own a house free and clear. For my parents, it'd be Scarborough, and that house is probably worth, I can't imagine it can't be worth 900 grand.
So I just one other mention, I guess,
Yeah.
is for contact. So we, I'm on Facebook, I'm on Instagram as well. Our company, Aliferous, right? ALIFEROUS. We have a presence on Facebook, Aliferous Group. We're on Instagram. And then, of course, there's our website, aliferous.ca. And I have a bunch of resources there for investors as well. We call it the Investor Hub. And that's where I write my articles, and they're practical things. So I tend to write things that are going to be useful to people. It's not market speak. It's not, market fluff. I have nothing to gain by that because I'm not really trying to attract people to my website unless you're tenants. But for investors, it's just a resource that I like to create and share. So.
Yeah, you share a lot. Is it just for fun?
Yeah. I like to help others. I like to give back to the community. I don't really have any commercial interest in the sharing that I do. It's really more about educating and helping others. I just want them. I like people, and I like to see them be successful, quite frankly. But no, I mean, I don't take external investors, so I'm not doing that. Right. And my target market is primarily tenants, but helping landlords doesn't necessarily get me more tenants.
There's plenty of tenants, so it's not something we need to necessarily compete over. You also volunteer as a vice president of Oreo.
Yeah, that's right. Yeah.
Does that take much of your time?
More than my wife would like me to contribute, sure. Right. But yeah, it's a little bit of time, but it's hard commitments, 2 evenings a month, and then there's some work in between. But myself, Victor Menashe, Michael Chan, Babette Turner, Jacob Homer, and Brad Cartier, we just volunteer our time to do this.
And it's unpaid. Just for
it's volunteer. Yeah, it's absolutely volunteer, and we do it as just our obligations. We're just members of the club that volunteer our time to do it, and then eventually we'll tire out, and somebody else will want to come in and basically do it. So, people within the Oreo club have each a lot of them have taken a turn to running the club. So this isn't my club. It's not Victor's club. It's the club, right? And we each volunteer for these positions and get elected in.
Cool.
So we have an election in May, actually. So when you do come down in June, right, we'll see if I still have a board position.
Cool. See if we're still invited.
It won't change a thing, right? So it's all locked in. So,
Excellent.
yeah.
Christian, great catching up with you. I'm impressed how much you're up to. I don't know how you do it and still like make the time to volunteer and talk to all your neighbors.
It's fun. That's why
Amazing. It's
I
very
enjoy it.
different than your tech job, I imagine. Is
Yeah,
it more
in
fun
tech,
than your tech job?
what's that?
Is it more fun than being?
Oh, I had a lot of fun in tech. I really did. But I, and in anything I do, it's not a job, right? It's focus. It's a hobby. It's what I live and breathe. So I can't do stuff halfway. It's just not the way I'm wired. In tech, I was one of these people that would work all hours of the day. It really didn't matter, but I enjoyed it. And we built some really cool stuff over the years. And now that I'm full-time in real estate, and I've been full-time in real estate since 2017. It's the same way. And I think I mentioned to you, my younger daughter joined our business almost 2 years ago, and she's coming up through the ropes, and that excites me as well. I kind of want to see her eventually take over the reins. It'd be wonderful.
Cool.
I could stop now. Honestly, I could stop. I could have stopped maybe 2 years ago. But I just have fun with this all the time. And as long as I have fun, I'll keep doing it.
Amazing. All right. Congratulations, Christian, on all your success.
Like I said, it's about fun.
And I'll see you June 8th.
Yeah. Hopefully in your nice shiny new Tesla.
Yeah, we'll see. No idea when it's showing up. I would just like to say goodbye to these gas bills. And like it rained like crazy this morning, and I need to fill my car. And like that's one of the use cases for having an electric vehicle. When I leave the driveway, it'll be full. The fuel tank will be full. I don't have to pump gas in the cold or rain ever again.
Yeah, well, there's definitely that. I mean, there's no need to charge up unless you're doing a long haul trip, right? But I think so. Electric, and I know we should probably wrap this up, but I'll tell you, electric vehicles are going to be really interesting in terms of not just what they do, including the autonomous vehicle side, but think about the innovation that's going to start to happen related to the electrical grid, right? Because you've got all these cars that are there and their batteries are all full. Now think about what happens when you've got, basically load sharing that has to happen. You're not relying completely on the generating side. So, to spin up a nuclear station in terms of turning the electricity up on that is, takes a long time. That's why they still have some natural gas generating stations. And then when you're taking a look at wind or solar, right, there's fluctuations and variance that happens there. But if you've got these batteries spread out all over the grid, if you're an electrical engineer, you'd understand the concept of capacitance. But basically, what happens is you're basically buffering all this electricity. But if you need to, you can kind of feed back to the grid, right, at times where there's a bit more demand on the grid. So it actually will be an interesting enhancement to the electrical grid over time. Now, this is going to take probably 20 years at least for this to happen, because you got to get smart technology to do it, right? Because the system is largely wired to feed demand as opposed to being able to go back the other way. Mm-hmm. But with the feed-in tariff programs, with people doing local solar generation, people already have the concept of being able to feed back to the grid. Well, this just adds another interesting dynamic to the overall mix. It'll be fun.
I'm really interested in seeing what happens with full self-drive, which I think will happen before 20 years. And you can essentially have your car be its own Uber taxi.
Yeah.
You can basically have a built-in designated driver.
Well, think about what that's going to do to public transit.
Oh, smoke it.
Yeah. And we've seen some towns already, instead of getting their own buses, right, they're literally just contracted with Uber to be their public transportation. I think Ingersoll, Ontario, is one city that did this probably 4 or 5 years ago. And there's a few other cities. I have to confirm that, right, because I'm just doing this from memory. But I thought that was an interesting shift. Now, if you go to autonomous vehicles, then that becomes much more feasible even in larger urban centers. Think about it as a feed in to a main transit. So if you've got light rail that is part of your main corridor, well, you could have these autonomous vehicles bring people to those stations, or at least main transit points. It gets really interesting.
Yeah, and it gets cheap. Transportation gets really cheap when you don't
But
have humans involved.
We get to see this in Ottawa, Erwin, right? Because Ottawa is got one of the few level 5 self-driving tracks, test tracks in the world because of our climate. So Ottawa is a hub for the evolution of autonomous vehicles.
The streets of Ottawa, or there's a track, you mean?
Some of the streets up
okay.
in Canada North, so in the major tech park there, so on Hartsburg and Leggett Drive and Terry Fox Drive, that area, that loop, if you just stand there some days, you'll see some autonomous vehicles driving around.
Cool.
So
that's cool.
It's becoming more and more common. Originally, it was a special event and everybody would come out to see it, but you'll still see them testing. And then they've got even the traffic lights and so on have special transmitters in order to enhance some of the autonomous vehicle things that they were working on. But our test track is actually not far from the Infinity Center. It's probably about a 10-minute drive from there. And it's a really neat little track there. But autonomous vehicles, you talk about within 20 years, I think most people are predicting it'll probably be about 20 years before the technology is really in what's called level 5 full automation. And then there's going to be another period of 10 years where there's a transition of those vehicles as well into the marketplace.
That's a long time.
Yeah, I'll send you an article that kind of describes the time frame and the evolution.
That long, eh? Crazy.
Yeah.
Cool. I'll make sure not to buy FSD for my Tesla. Did you buy it?
Yeah, I did for sure. Yeah. Absolutely, I did. Yeah. I just love that feature when I was just imagining, right? And I like to always tell my friends this. So think about when you're in a mall, right? It's raining cats and dogs. Your arms are full of things that you just bought. And normally you'd have to try and run through the rain, get to your car, put the stuff in, or you'd have to have somebody wait with your stuff while you go get the car. But with the full self-driving, you can summon your car to come pick you up. What's not to love?
I'll just order all my stuff on Amazon and Costco delivery.
No, I kitted mine out, right? So the good thing is I paid it, I've locked in at January of 2021 prices, right? And we'll see when I actually get the car.
It's hilarious. You still bought the full self-drive. That's awesome.
Oh, for sure. Yeah.
Amazing. Yeah, that'll be a fun toy. That's like a fun trick.
Yeah.
Christian, again, thanks so much for doing this, and I'll see you June 8th.
Right. See you. Well, we'll probably see you in May, right, at the Multifamily.
Yeah, that's right.
Conference as well.
In like less than a month.
Yep.
Crazy.
So we'll see you there, and then we'll see you in June again.
Amazing. All right. Thank you, Christian.
Well, thank you for having me, Erwin, and see you soon.
Thank you for listening. If you want to learn how to invest in real estate from scratch, my team teaches beginners how to use the #1 investment strategy in a virtual free training class every month. Go to investortraining.ca/podcast to register for our next class. I publish an episode here every week, so subscribe if you want to keep learning from seasoned investors like myself and my guests. Again, if you're ready to learn the nitty-gritty about real estate investing, register for our next free virtual training class at investortraining.ca/podcast. Again, thanks for listening to the show. Talk to you next week.